All right, let's jump right into this explainer. We're exploring the super high-stakes world of asset management today. And look, this is a space where your financial guide's transparency isn't just, some polite courtesy. It can literally mean the difference between preserving generational wealth or facing totally devastating, unrecoverable losses. Every single year, massive amounts of capital are just wiped out because of opaque financial advice. So today, we're unpacking the critical industry standards that define exactly how financial institutions have to communicate with us, the customers.
Think of an asset manager kind of like a guide navigating you through a dangerous, uncharted jungle, right? If they don't explicitly explain the risks of the path they're taking you down, especially when we're talking about complex, high-yield financial products, well, it's you, the traveler, who ultimately gets hurt. And if that guide gets paid just for taking you on the trip, regardless of whether you actually survive the trek, their incentives are completely out of whack. You absolutely need to know exactly what you're walking into. Section 1. The fiduciary foundation and your guide's legal duty. So to really get why this transparency matters so much, we have to start with the baseline expectations asset managers legally owe to their clients.
The entire regulatory environment is built on one really straightforward concept: aligning the firm's interests with yours. Because asset managers usually earn fees based on your AUM, the total amount of assets under management, this structure is supposed to naturally encourage them to grow your wealth and actually act in your best interest. It's all about providing investment strategies that precisely match your specific risk-return profile. So a 30-year-old investor might want aggressive, high-risk growth for a long-term nest egg, but a 70-year-old retiree, they absolutely need stable, low-risk income for daily expenses. Nailing those profiles correctly is literally the bedrock of preserving long-term value.
Moving to Section 2, the cost of broken trust, where high yields mean higher stakes. What actually happens when that alignment totally fails? What if a firm pushes complex financial products without making sure the client gets the risks?
Well, let's compare the outcomes. Maintaining perfectly aligned risk-return profiles, that preserves long-term value and builds immense trust. But on the flip side, failing to transparently explain the risks of complex products like extreme market volatility or deep credit exposure leads to catastrophic breakdowns. Imagine a broker selling highly volatile derivatives to that risk-averse retiree we just talked about. It's a total recipe for disaster. Trust takes decades to build and mere seconds to destroy. For the firm, this kind of communication failure triggers lengthy, incredibly costly litigation, a total loss of client trust, and ultimately a massive outflow of assets and plummeting sales.
Section 3. Tracking financial transparency through the SASB standard. So the big question is, how do we actually track if a firm is honoring its fiduciary duty, or if they're just hiding behind a wall of complex financial jargon?
Well, the solution lies with the SASB standards for asset management and custody activities. SASB stands for the Sustainability Accounting Standards Board, and they have codified exactly how we measure this transparency. They lay out specific, standardized disclosure metrics to evaluate how well these entities manage the very real risks of providing fair advice and transparent info to everyday customers.
Section 4. Measuring losses and violations with the hard data. Let's look at the quantitative side and see how this framework builds a clear picture of corporate accountability using undeniable data.
Under the very first metric, which is FNAC 270A1, regulators and investors look specifically at the human beings making the calls. We're talking about licensed employees and what are known as identified decision makers. These are the senior managers and directors who hold individual accountability for the firm's investment business. And this is huge because tracking the individuals rather than just the faceless corporate entity stops firms from simply paying massive fines and writing it off as just the cost of doing business. It forces absolute personal accountability for giving bad advice. Firms can't just bury their bad actors in the fine print anymore. No way. They are required to clearly disclose the exact number and the percentage of these licensed employees walking around with a history of regulatory violations, consumer-initiated complaints, or private civil litigations. When you compare the slice of employees with a totally clean record against those with a troubled past, it paints a remarkably clear picture of the professional integrity embedded inside that specific firm. Now, looking at metric FNAC 270A2, the focus immediately shifts to the raw financial fallout. Firms have to explicitly report the total amount of money lost due to legal proceedings tied to marketing, false advertising, mis-selling products, or just a general lack of information transparency given to their customers.
And keep in mind, this massive number they report completely excludes the firm's own legal defense fees and internal expenses. It is strictly a measure of the pain inflicted by regulators in the courts. We're talking about the penalties, the fines, the restitution, and the civil settlements paid out directly because the firm failed to provide transparent information and fair advice. It's literally the price tag of opacity. Section 5. The blueprint for fair advice in informing the customer. We've seen the devastating monetary and reputational risks, so how do firms actively prove they're doing the right thing to prevent these losses?
Under metric FNAC 270A3, firms have to provide a highly detailed narrative. They must explicitly describe how they disclose the risks of complex or high-yield products, things like intense interest rate sensitivity and liquidity concerns. They have to explain exactly how they ensure an investment is actually suitable based on real due diligence. They must lay bare any conflicts of interest, like say if client commissions are paying for internal research. And crucially, they must detail if their representative's compensation, like their year-end bonuses, is directly linked to specific product sales volume targets. Think back to our jungle guide for a second. If that guy gets a massive cash bonus for dragging you through the most dangerous snake-infested swamp regardless of your survival rate, that creates a profoundly perverse incentive. They might sell you a hazardous financial product you absolutely do not need just so they can buy a new boat.
It's not just about what they say, though. It's how they actually execute that communication. They have to map out the exact steps of their strategy. Are they using dense prospectuses, website listings, or clear verbal communication? And most importantly, how do they tailor this info differently for a retail client versus an institutional client? To put that simply, retail means an everyday person saving for retirement, like a grandmother trying to protect your savings. Institutional means a massive entity, like a pension fund or a Wall Street hedge fund. The way you communicate profound financial risk to that grandmother has to be fundamentally, structurally different than how you communicate it to a room full of seasoned Wall Street analysts. Firms also have to show the internal controls they rely on to guarantee this plain language transparency is flawlessly executed across the entire organization.
So armed with this explainer on the SASB standards and the really severe business risks of opacity, you now understand exactly what your financial institution is legally obligated to tell you. If they aren't fully transparent about the risks, the conflicts, and their own compensation structures, you have to stop and ask yourself the most important question about your financial future. Is your asset manager truly optimizing your returns or just their own?